So let's get right into it. The big question on everyone's mind. After all the hype, the crashes, and the chaos, is crypto still even relevant? We're going to tackle that head-on today, and more importantly, we're going to build a real strategy for how to think about it as we look out toward 2026.
Look, it's no secret the last couple of years have been an absolute roller coaster. We all lived through the crypto frenzy, right? It felt like a period of just insane hype, where your neighbor, your cousin, everyone was suddenly an expert. But of course, that was followed by some gut-wrenching volatility. And it's left a lot of people wondering, was this whole thing just a flash in the pan, a fad, or is there a real opportunity sitting quietly in the background?
And hey, this isn't just a feeling. You can literally see it in the data. As we look at the numbers from early 2026, the Crypto Fear and Greed Index is screaming extreme fear. Bitcoin has pulled way back from its all-time highs. And interestingly, instead of acting like digital gold, it's often behaved more like a risk-on asset. What that means is, when the stock market gets shaky and investors get scared, they sell crypto too. The fear out there is real.
This right here, this really hits the nail on the head. We're in this weird moment where there's more involvement in the financial markets than ever before. But, and it's a big but, it's often with the least amount of knowledge. And that gap, that's where the danger is. That's what skyrockets your risk. So the entire point of this explainer is to arm you with a framework, a way of thinking, so you can stop just speculating and start building a real, structured strategy.
All right, so here's our game plan for today. We're going to start by building an investor's map using what I call the 4 pillars. This will cover what to buy, when to buy, and how to use it. Then we'll take that map and build a specific strategy for 2026, and we'll wrap up with what is, by far, your single most valuable asset in all of this. Sound good? Let's dive in.
To get through any market, especially one that's as choppy and unpredictable as crypto, you absolutely need a map. Our map is built on 4 core pillars. These are timeless principles that can guide you even when everything feels like it's going haywire.
And here they are, the 4 pillars of investing. First, fundamentals, which helps us answer what to buy. Second, technicals, which is all about when to buy. Third, cash flow, which decides how an asset is going to work for you. And last, but certainly not least, risk management, which is all about how to survive. And the really cool thing about this framework? It's not just for crypto. You can apply these exact same principles to stocks, to real estate, to anything.
Okay, let's start at the beginning with Pillar 1, fundamentals. This is the bedrock. This is the why. Before you put a single penny into anything, you have to understand the basic reason that asset even exists. Why does it have value? With something like crypto, this step is absolutely non-negotiable. So what is the fundamental argument for crypto? Well, at its very core, like this quote says, it's a direct response to a loss of faith in our traditional currencies. When you hear about central banks printing money or quantitative easing, that can lead to inflation. And what's inflation? It's your hard-earned money in the bank buying less and less over time. And that brings us to this idea of a hedge. It's a pretty simple concept. As people watch their dollars or their euros lose purchasing power year after year, they start looking for other places to put that money. They're looking for something that will hopefully protect its value. For centuries, that was stuff like gold. But today, a lot of people see cryptocurrencies as a new, digital way to do the exact same thing, to hedge against the devaluation of their money.
But, and this is key, to really get crypto's risk profile, you've got to have the right mindset. Let me give you an analogy. Think about the difference between investing in a huge, stable company like Procter & Gamble versus a tiny startup that's literally just 2 people in a garage. Procter & Gamble is solid, it's low risk, but it's probably not going to grow 100 times over. That garage startup, it has explosive potential, but it also has a massive risk of just poof, disappearing.
In this right here, this is the perfect lens for looking at crypto, especially the smaller projects. You have to think of it as a nano-cap investment. The upside is huge, right? It's like getting in on Apple when Steve Jobs was literally building circuit boards in his garage. But the risk is just as big. It could go to the moon or it could go straight to zero. It's the definition of a high-risk, high-reward play.
All right, so we've covered the what and why with fundamentals. Now let's get into the nitty-gritty. Pillars 2, 3, and 4 are all about the practical side of things, the when and the how of actually making a move. So Pillar 2 is technical analysis. This is all about answering that tricky question, when is a good time to buy? Instead of just throwing a dart at a board, technicals use things like price charts and volume to try and read the psychology of the market. It's about spotting trends and key price levels where things might be about to change.
The goal isn't to perfectly predict the future. Nobody can do that. It's about making a more educated guess based on how the crowd is acting right now.
Next up, Pillar 3, cash flow. This is about deciding what job you want this asset to do for you in your overall plan. Is it a simple capital gain play? You know, the classic buy low, sell high? Or are you looking for it to generate some income, maybe through things like staking or DeFi protocols? Or maybe its main job is just to be that hedge we talked about earlier. You have to know what its purpose is.
And that brings us to the last pillar. And I need you to listen closely here, because Pillar 4, risk management, is, without a doubt, the most important of them all. It is the one thing that is completely non-negotiable. I don't care how brilliant your idea is or how perfect your timing feels. If you don't manage your risk, you will not survive in these markets. Period.
I absolutely love this analogy. It just perfectly sums up what you can and can't control. You and I, we can't control the market. We can't stop a crash from happening any more than a passenger could stop the Titanic from hitting an iceberg. But what we can control is our own preparation. We get to decide if we're going to step onto that ship with a lifeboat. And in the world of investing, your risk management plan is your lifeboat.
One of the most important tools for building that lifeboat is something called position sizing. It sounds complicated, but it's actually really simple. It's just deciding how much of your money you're going to put into any single investment. It's not about how much you hope to make, it's about controlling upfront how much you're okay with losing if you're wrong.
Okay, let's make this real. Imagine you have $10,000 and you're thinking about putting it into one of those small, high-potential crypto projects. You know, a real garage startup. How do you use risk management to make that decision? Here it is. This is the golden rule, especially for speculative stuff like this. You have to be 100% okay with that $10,000 vanishing into thin air. You have to be able to lose every last cent and still sleep soundly at night. If the idea of that happening ties your stomach in knots, then your position size is too big. Simple as that. This mental check is your ultimate lifeboat. Okay, so we have our 4 pillars, we have our map. Now let's actually use it to put together a strategy as we look at the market heading into 2026. And remember, a strategy is not about predicting the future. It's about having a plan to deal with an uncertain one. This is how we build our small cap strategy. The very first step is to just accept the uncertainty. You've got so-called experts predicting prices are going to soar to the moon, while the actual market data is showing extreme fear. A good strategist doesn't place a bet on one of those outcomes. They build a plan that can work in the current environment. And the biggest thing changing the environment for 2026 isn't the price, it's maturity. And that maturity is coming in the form of regulation. As of January 1st of this year, a new global framework called CARF is now in effect. And what it means is that crypto transactions are now being automatically reported to tax authorities. The old idea of hiding assets offshore, that's over. So let's apply our pillars. Fundamentally, the Wild West days are done. This adds some legitimacy, for sure, but it also means crypto is no longer anonymous. Technically, the market is in extreme fear, which for some investors is a signal that it might be a good time to look around. So the strategy for 2026 isn't just to buy blindly, it's to find those promising garage startup projects, use the market's fear as a potential entry signal, and most importantly, apply ruthless risk management because they could still go to zero. That is the strategy. This all brings us to our final and, honestly, the most important point of this entire conversation. We've talked about frameworks and strategies and the market, but through all of it, what is the single most valuable asset you can possibly have? The answer isn't Bitcoin. It's not Ethereum. It's not any single coin. The most valuable asset you own is your knowledge. It's your financial education. It's your understanding of timeless principles like the 4 pillars, because that is what will allow you to adapt and succeed in any market. That knowledge is the real asset, because you can take it with you and apply it to every single opportunity you see for the rest of your life. So I'll leave you with this question, which is inspired by the book Rich Dad, Poor Dad. Are you going to be someone who just lets life and the markets push you around, reacting to every bit of hype, every wave of fear? Or are you going to take control? By educating yourself, by building a framework, you stop being reactive and you start being proactive. You become an investor who's actively building their own financial future. The choice, as always, is yours.